Everyone to the meeting of the Budget and Finance Committee of Sun City West. The committee is meeting in person today. I hope we have some people who have joined us to listen in or on Join Me. But the first order of business, we have established a quorum. We have every member of our committee here. The minutes from February 16th have been distributed. Do I have any changes or corrections that need to be made for these? If not, do I have a motion to accept these as written? Thanks you, Harry. Second. Thank you, Lou. By consent, these are approved. Thank you. Our first item on the agenda is our Vanguard presentation from Andrew Maslick. Do you know if he's on the line yet?
I don't believe so.
He's not on the line?
I don't see him on line, no.
Okay. I'm going to go ahead and go to the next item on the agenda, which is the Pickleball expansion update. Ken Holtz from the Pickleball Club is here with us today. Ken, are you president of the club?
No, I'm not. I'm not president of the club. Eileen Freiberg is president.
Okay.
I serve as an advisor to the club and project leader for this particular expansion project.
Okay, thank you, Ken. I have shared with the members of the committee all of the slides and information that Ken has presented, and I'm going to let Ken give a little short presentation, and then we'll open it up for discussion and questions from the members of the committee. So Ken, I'll let you take it away. Is your mic on?
Yes.
Thank you.
Very briefly, I just want to provide you a status report of how we got to this point in the process. Basically, we've been participating in the capital development process since the latter part of 2017 and all through 2018 during the spatialization formal review for Sun City West as recommendations were made at that time for the master plan. For a variety of reasons, we all know these things take time. So we gained some traction during 2020 to get back into the formal process, including the development of the CR13, club approvals, and then working through the process of presentations to different respected committees, of which we're at one today. So the status of that simply is we've provided the CR13 to clearly demonstrate what is our request. We've supported that with evidence in terms of club activities, utilization, growth, trends, historical and future. We've involved the club along the way in terms of keeping them communicated, up to date, and of course having their vote to support moving forward when it's appropriate. As far as the committee status, we've met with charter clubs and received their recommendation of support. We've met with property. They have delayed their recommendation based upon the decision of the governing board of March 5th to once again revisit the master planning process, which we respect. And we're here today basically for the same purpose, to just answer questions. So we understand that a decision was made by the governing board to look back into the ever need of the community, which makes sense, and that's the master planning process. That'll take some time. That potentially presents a delay in our plans, but we have to respect that. And we look forward to it only because we know it's going to provide a better solution long-term for everyone involved. So ultimately, we keep working the process. We'll stay very involved in that process, and we'll provide you whatever information you need to make good decisions. The confidence we have is high in that this thing called pickleball, which has this strange name, continues to be a phenomenon all across the country. Specifically in the demographic that we are very concerned about, the 55 plus, because it's the largest segment of the sport. It's the fastest growing sport in the country. And the fastest growing segment of that sport happens to be 34 to 50. So the next 5 to 20 years also looks very promising in terms of what's going to happen. Ultimately, we're blessed with virtually an untapped demand. So it's very important for our club leadership to really be on top of things, to demonstrate the correct programs, the evolution of the sport, the ability to play it for recreation, play it for skill-based, provide competition, provide fun social activities, because it's a careful, balanced sport that provides unique benefits for not only activity, competition, but the social networking that arises out of it and the friendships made are just monumental. So we're positive in terms of what will transpire in the future. And ultimately, our job is to continue to provide the satisfaction to our members to allow it to grow, and the responsibility of the association deemed it's necessary is to provide the space for it to grow. Our job is to make sure we utilize that space. So I like to think of it in terms of member currency. It's a term I use that, you know, when you think about your lives at this stage of the game, the most important thing to us is what we choose to do. Because we only have so many hours in our lifetime, and at this neck of the woods that we're in this time frame, what we choose to do ultimately determines our satisfaction in our lifestyle at this point in time. So the member currency that I try to measure, it relates to pickleball, is what do people choose to do, how often they choose to do it, and what amount of time do they allocate to that choice. And we feel very confident that pickleball probably serves at the top of that list in terms of activities in this community. So thank you.
Thank you, Ken. I wasn't sure if I garnered from your comments, are you supporting the master planning, looking at this and delaying this? Are you wanting this to move forward?
We're ready to move forward when the community is ready to move forward. In other words, we manage a club. We know that actually COVID, one benefit of COVID, it has provided us some relief in terms of we can't have all of our programs moving. We have 51 different weekly programs that we manage. We probably have 11 of them open right now.
Okay.
And hope to open a lot more in the near future. So we're anxious to turn the switch back on. And when that happens, some exciting things can happen. But we're also moving towards a declining activity period of the year, so that gives us some relief. The January to April period is the high season. That's the season we are the most active, as most activities in this community, but it's also the time when everything has to work, otherwise the community doesn't work. So next high season, 22, will be a challenge for the club, but it's one that we'll work through. We'll manage it.
Sure.
Ultimately, it takes time to build something of this scope, and it requires appropriate planning, and of course, the correct decisions of where and the potential for that can be.
Okay, thank you. I want my committee to ask questions, and ultimately, we need to give our recommendation from the Budget and Finance Committee to the board, the governing board. So I'm going to open it up for my committee members to ask any questions that they may have, and I'll just go around the room. Kathy?
Yes, could you just talk a little bit about the financial arrangement?
Well, the scope of the project from the planning and the information we've received back from projects can range anywhere from 1.7 to 2.5 million in scope in terms of total project costs. So any particular details of that you're interested in?
The club share versus Sun City West share?
Sure. Currently, the policies of Sun City West provide for clubs needing expansion to participate in that expansion financially. That participation is described as participating up to their ability to participate. As you know, some clubs haven't found their ability or maybe are more restricted than others. We happen to be a very popular club. We attract the eyes of many people within the community and beyond the community in terms of wanting to support our club. As a result, we have ability. We've carefully practiced that within the confines and rules that we were provided, and we've analyzed it to be able to provide a number back to the financial planning aspect of this project so that we would be able to commit up to $960,000.
And is that a one-time, you would pay it one time or overtime?
That's overtime. In other words, it's not available today.
So per year approximately?
We talked a time frame of 12 to 15 years, and that's predicated upon past experience of our ability, because this isn't the first time we've expanded. This is our third expansion within our history. By the way, we're going to be celebrating 20 years next year.
Okay. Gary?
You may want to skip me and come back, because I've got a raft of questions.
Okay.
As do I.
Do you,
Go ahead, Gary. Yeah.
Gary, go ahead. I think we may have some duplicate questions, or may not, but let's just go ahead with our question.
I'd be remiss if I didn't acknowledge Ken. I've been a good friend for a long time and kind of been the tip of the spear on this pickleball thing for a long, long time, as well as Hickory Golf. Done a wonderful job with that. But you're a salesman, and this presentation was that. I've read it so many times. I've got many more questions than I had when I started. I knew nothing about pickleball before last week when I got this, but I couldn't help but feel that there's a parallel path with golf, and there's a lot of similarities. In fact, probably half your members are golfers as well as pickleball players, I would guess.
Correct.
So when I think about just setting some context, pardon me, but 1993 we had 440,000 rounds of golf in this community. Huge, unfathomable. I can't even imagine how they did that. 1994 we built Deer Valley. 1995 we built Desert Trails. The clubs in those times had 600 members in each of the men's clubs. So things were just congested as heck. Today, we had a look back at the number of rounds of golf for the last 10 years, and it's plateaued between 275 and 292. So that's about where we are. And it's not expected to grow at great lengths in the future. When I look at your projections and I think about where you're projecting your membership to be, at some point, all organizations plateau. And I would think yours is probably still on a growth curve, but maybe not to the extent that what you're reflecting, but you're being conservative, 3.5%. But from 2015 to 2019, you lost about 300, or you gained about 315 members a year. And during that same period of time, using your 85% retention rate, you lost 200 to 250. So
Right.
you're replacing about 40 or 50 members a year, and to get to these levels, it's going to take something different than what you're currently doing, and I understand that. Get to the nub of my questions. The first one, you've emphasized the high season. Golf is the same. The high season, between April and January, golf does 50% of the annual rounds. And if you add November and December, it's 70%. So 70% of the rounds in 6 months. You're kind of the same thing. And when you look at the number of hours that you've used in your projections, 7 and 9, I don't understand it. I really would like some more information from you on how you use that. But what I would like is almost an hour breakout on what your usage is. I can read the chart, and it's kind of a roller coaster, but at the same time, when we did that for golf, 5 or 6 years ago, an ill-advised board member had it as an agenda item to eliminate a golf course. So it didn't eventually happen, of course, but he was adamant about that taking place. So we had to do a lot of work to try to convince people that that wasn't smart, aside from the legal aspects of it, which is just crazy to think that we can do that. So anyway, we got to where in March and April, we were using 95% of our tee times on all of our courses. On the collar months, we were using up to 85%. So the usage was very compressed in that period of time. And I guess what I'm saying is, if this expansion, you're asking for 31% increase in the number of courts that you have, I don't expect that you're going to have a 31% increase in playing or units and the way that you measure the way people participate. So I would really suggest that if we need to sit down together and walk through it, I'd be happy to do that. But something similar to what we did in golf, tee time by tee time, hour to hour, you're using 7 and 9 hours. There's many times when you're open for 12 hours a day to play. So how much of that isn't used that could be used? Golf, believe it or not, uses only 27% of the tee times available for the entire year. And that's a funny number because of the summer, but that's still a lot of inventory that's not being used. The other thing that I wish you would take under consideration is what other age-restricted communities are doing. When we got into looking at some of the golf changes that we made, we looked at a lot of those and we learned some things that we should do, and I'm sure that you may have already done this, but at least the Del Webb communities and then the others between South Carolina, Tennessee, Florida, Texas, Nevada, they all have communities very much like ours, and what I'd like to know is the number of members that they have and the number of courts that they have. For instance, in your case, 1,600 members using your number, 26 courts, that comes to 62 per court. The Grand across the street, 1,439 members as of Monday. They do a really great job of updating their website. 22 courts, that's 65 members per court. Sun City hasn't updated their website in ages. They've got 28 courts, and they say they've got 600 members. That can't be, but 8 of those are covered, and I'm sure you've looked at those already as kind of a what if in our case. So if you don't have it, I think it'd be worth the conversation with other communities to find out how you rank with them, or how all that plays out, because you're asking for a lot, and you have a right to, because you've been the fastest growing club over a large number of years. But at the same time, the space that you're looking at is very valuable. You may have the best argument for it, but to commit to that and then 5 or 6 or 7 years, that's the parallel to golf. We might regret the decision. I hope not, and I don't think not, but to be determined. The last point I would make is, based on your information that I found very interesting, 53% of the days of the year, you either have no or small amounts of play. And that's a combination of the heat and the rain. And of course, rain we don't see very much. I didn't try to figure out what the wind would be, but that's a lot of days of no activity. So even more so now, we're compressed within this 4-month period of time. And if we're talking about increasing the number of courts 30% for 4 months, so members can have their preference when they play, I don't know that that's a good plan. If we're doing it because we're going to expand the membership dramatically, and that'll give people more options over a greater period of time, then I think that's a worthy cause and a worthy consideration. So I've got many others, and I don't want to take more time. I've already taken too much, but those are my thoughts.
Sure. Well, let me address, first of all, we do track virtually everything that you're requesting, and I can provide it to you. Not at this time, of course,
No, I
because
know.
it's a detailed report. But specifically, the high points would be, and I'll work backwards, the relationship of missed opportunities for access of play, which is days we can't play today because of the structure of outdoor play and what covered courts would provide. Actually, the major benefit of that is outside of that high season, because the high season affords the most opportunities of good weather days. But the expansion for that would provide the club an additional 15,000 sign-ins if we had those 8 covered courts today. And that's outside of the high season. So it does expand during the shoulder temperature months, the rain periods that occur kind of in blocks of time that are predictable and documented through the weather services, and then also through the wind activity, only because of the nature of the ball we play with when it's an outdoor environment. It goes kind of haywire sometimes. So. The other aspect is benchmarking against other communities. Of course, we stay right on top of that. A quick example simply is Pebble Creek. Pebble Creek is a much smaller community, still building out community than we are. Will always remain smaller than Sun City West because they're restricted in terms of acreage. But they are a very high developed, a little bit younger community. I think they're a 50-ish restricted community, whereas we're 5 years older. And growing younger. So but they're a highly developed pickleball club, very much like us. We still proclaim to be the world's largest pickleball club, but they're close at our neck. They're near us. Even though they have much fewer rooftops, they have currently, I believe it's 22 courts, but they also have a 16-court project in development in terms of planning and getting accomplished from a decision perspective. Festivals, another opportunity to look at. Comparable Del Webb community, that originally started with 8 courts, quickly added another, I think it was 18, and now are requesting another 18 for build-out. Their biggest challenge there is because the decisions are being made by builders still, because they're building out, builders are reluctant to cut into their profits with additional amenities before people are actually purchasing homes. So they're in that phase now where they're starting to talk to, because they know they're going to be built out over the next period of time, and they already have the plan for what is that management process past builder stage, and they're already in dialogue with that management process to provide additional amenities for that. So we do watch that very closely. So if you compared our community, our size club, to per capita, per other comparison issues, we're behind the curve. In other words, if we were being compared to Pebble Creek's development, where would we have? We'd have 69 courts today. So, but I'd happy to sit down and discuss all of that with you.
Great,
Okay?
thanks.
In the interest of time, I don't want to cut off any pertinent questions, but I'm going to ask the rest of the committee to kind of stick to maybe 2 questions, and then we'll go around again if we still need some more time, because we do have a pretty aggressive agenda today we need to complete. But I don't want to miss anything that needs to happen. So Lou?
Good morning, Ken.
Hey,
Welcome to the BNF committee.
thank you.
I will hold my questions, but if Gary and Ken get together, possibly, I hate to call everything a subcommittee meeting, but I have similar questions as Gary did. Mine are more fiscal in that I believe the #1 complaint of residents is noise. So I've done a fair amount of research on different materials, green paddles, green balls. There are several companies that provide sound dampening materials. I like the idea of the covered courts as opposed to the open courts because it encapsulates the noise. So the #1 issue, as I understand it, is not some, from the residents I talk with, is noise. You know, you want to expand to area X, area Y, area Z. That's the biggest issue. So if Gary and Ken want to meet, I'd like to sit in on that meeting. And I'll hold my questions till then. Thank you.
Lisa, do you have questions?
No questions. I'll wait for information to come later.
Harry, the same. John?
I have a couple questions.
Go ahead.
to fill in. First, Ken, my compliments on this presentation. My compliments on this presentation. It was extremely well done and comprehensive, understandable in most regards. I've got a couple questions about my understanding of a few of them. And I'll be as positive or as quick as I can. In terms of the 2 alternatives of Kuntz or expanding Palm Ridge, from the club's point of view, is it a positive, a negative, or a neutral to have the courts spread out in 3 facilities versus 2?
Well, if you've been involved in managing any large organization, there's always 3 camps. 3, a third love you, a third hate you, and a third don't care. So basically, there is no wrong answer in terms of expansion. The ideal answer, of course, is 1 location, but oftentimes the 1 location that is on the docket may not be the best solution for a variety of reasons. So the master plan ultimately should satisfy some of that in terms of locale, management, best utilization of current resources, and that's what the master plan is all about. The club's job is to grow, to satisfy, to provide programming. Ultimately, that can be exercised in many different right answers.
Okay, thank you. That was a good tap dance.
Well, it's the truth.
Well done. Okay, my next question, because I know time is important. On your attachment 3, the 2 graphs, I confess I didn't understand graph 1. I'm wondering if you could explain that. And then on graph 2, I have a couple questions after I maybe get an understanding. If I had trouble understanding, it's possible maybe some others did.
Just as a brief generalization of what is attachment 3. Attachment 3 talks about utilization of existing space available, meaning that as we make this choice of activity and we invest amount of time against that activity, how much space is available to provide benefit back. So over time, that space has changed. We started with 3 courts in the tennis facility. We then expanded to 13 courts, plus 10 at Palm Ridge. Then we expanded plus 8 at Palm Ridge, bringing it to 21. Then we expanded 8 additional courts, but lost 3 courts in the tennis facility. So we netted 5 more with the expansion of the R.H. Johnson facility standalone out here by the men's club. So basically, that's a measurement over time of amount of space available and the activities through the measurement dimensions that this community uses to track that. In other words, your system is what every club uses. It's not a perfect system, but it's one that demonstrates over time trends and good enough data to track activity. And it's improving. In other words, I'm hearing some new things that are coming along to help clubs measure their activities a little bit better. But given that system, it shows the number of sign-ins or decisions made by people to invest time to participate in that particular activity in a given amount of space. And so you can look at it based on number of courts available, what happens to sign-in activity over a period of time.
Okay.
That's chart number 1.
Well, I guess I'm struggling. I'm not a pickleball player, but I see that number, 1,372.
That's during.
What is that?
That's 1,372 sign-ins that occurred from the period of January through April, the high season as we define it,
Okay.
per court available in Sun City West.
So it's 1,372 sign-ins times
Times the number of
times the
courts.
number of courts available.
Correct, yeah.
Okay.
So in other words, another way of looking at that time frame in 2019, it was approximately 37,000 sign-ins, about 90,000 hours of occupation.
Okay, then if this is a test for me. You give me a grade on this. My understanding then is the community has kept pace with adding courts, have kept pace with demand because the sign-ins per court is pretty consistent.
Well, and it also is a reflection, it's like a barometer. In other words, we're watching that curve because we know when it keeps bouncing off this level, it's an indication of the future that we potentially need more space.
Yeah, and maybe a bit of a proxy of how many turndowns if the number got high enough. So, good. That's good. That helps me understand that chart. And then on the second chart, what I see is, I see a 3-week period, and I kind of think of this as like Venn diagrams, where you have the high season on one hand and demand, and on the other hand, you have the usage of the, you have, on the one hand, you have the people, the influx of people and more players, and then on the other hand, you have the weather. The weather gets nicer from mid-February to April, and that would bring people out. So together, those produce a big spike. And I see about 3 or 4 weeks there where it obviously jumps way up, the last 2 weeks of February, maybe the first 2 weeks of.
But it also reflects event management. In other words, the activities, just like any, well, not all activities, but many of the larger club activities have a variety of programming or events that attract different levels of participation. In other words, for example, we do a day for charity once a year. We haven't done it this year because of COVID, but typically we attract 500 people to that event, both a combination of members and citizens of Sun City West to raise money for charity. Well, it's a facility use, so it's tracked, okay? Now, are all those people playing pickleball? No, but they're using the facility.
Yeah.
And you need to track that for bathroom use and parking use, and are the sidewalks wide enough to facilitate that? It's all part of the system of measuring space utilization.
Okay,
And those spikes, because those events typically happen during prime opportunities of weather, happen in January and February, and March, rather.
yeah. Okay, then my last question on this is, are guests permitted to play pickleball? And if so, under what conditions and what restrictions?
Sure. First of all, we're not a closed club. In other words, we're not a wood shop, metal shop, where you gotta have to have certain credentials to walk through the door for primarily safety reasons. But yet, we are a club that has a first priority for scheduling. In other words, through the process of May 1 requests and all of that, and we schedule our activities throughout the coming year. But if you looked at, the easiest way to look at that would be to go online at there's an online court reservation system that the club brought to the rec center for utilization for everyone. And so we were able to put our footprint on that court reservation system for these 51 different programs when we were able to block out 4 courts for the pickleball divas and 8 courts for the picklettes, and so on. There's 51 different ones of this patchwork quilt that we schedule throughout the whole day. But within that, there's all these white blocks. And these white blocks are open time for the community to use pickleball, okay? And that's both at the Palm Ridge courts and at the R.H. Johnson courts. But on top of that, there's also what we call the 10% rule, because we are a common use club, residence versus club activity. We set aside a minimum of 10% of our space 100% of the time for non-sponsored or non-scheduled club time. So the community can walk in and play anytime they want, or reserve those courts anytime they want. So community use of pickleball is been ongoing. It's something we support. We provide the balls when we're able to. During COVID, we weren't able to, but we provide the balls for the community. We provide the paddles for the community. We give them to the rec center to hand out to people. We encourage people to come to our, when we can have it, and we're going to start it back up in April. Our Monday, we have a 90-minute orientation to pickleball that's open to the community. We have on average 1,500 people that come to that every year. People sometimes show up 50, 70 people at a time on a Monday. It's amazing. It's truly amazing.
What about outside, non-resident guests?
Non-resident guest management is handled the same way as any guest policy of the association. According to our bylaws, we follow the recommended procedures so that a non-member doesn't have any more advantage to access to the community than a member, which is the standard.
Okay. Thank you very much. I'm seeking information.
Sure.
It's not judgmental.
Good question.
Yeah. And then one last comment. This is not another question, and that is directed toward Carl. Carl, in taking Gary's comments to heart, I was also, while he was talking, I was thinking of the bowling mania of the 50s, and many, many other examples are, I'm sure, out there about trends that come and go and then recede. Would it be at all feasible that if this project advances and there's estimates made on developing this and building, that it also would include a contingency if we had to tear them down? You know, a few comments on the tear down cost might, I wouldn't want to think about overbuilding and get scared off of going ahead if the cost to dismantle was, insignificant, let's say, at the end of its life, or if we made a bad decision and overbuilt, what's the cost of correcting that error? It's all. Just, it might not be a feasible idea, but I just wanted to plant a seed with you, Carl. That's all. thank you for your time. I know we're pressed.
I thank all of you for your questions. I'm sure that we probably could stay here all day and debate this, but I want to remind my committee that we are giving a recommendation to the governing board. That is it. We will have a chance later on in the budget process to vote line item on each of the items over 50,000. But in the interest of our time today, I'd like to try to wrap up a discussion and get some type of information that we could pass on to the governing board from our committee.
Ann?
Kathy, yes.
I just want to read one paragraph's article I read today, and then I'll make a motion. There are an estimated 68 million so-called Zoomers, or Generation Z, in America, people born between 1997 and 2015. They've been driving the growth in all racket sports, including tennis and pickleball. According to the SFIA, an impressive 22.4% of Zoomers played some form of racket sport last year. So from my perspective, this is looking out for keeping Sun City West alive and well. If you can't access some things, you'll look somewhere else. So with that in mind, I would move support of this project going forward.
Do I have a second to that motion?
I'll second it.
We'll just do a voice vote by our members. Kathy?
Yes.
Gary?
We're voting on moving the project with a recommendation.
To the board.
To the board, to the board.
Yes.
We still have final say.
While Gary's waiting, I have to abstain. I don't have enough information.
Okay. Okay, we have 2 abstain, we have 1 yes. Lisa?
Yes.
Harry?
Yes.
John?
No, I need more information. And I also have a second comment there. That I think this is a very strategic project. As a community, a core competency of ours is incremental expansion and incrementalism. We are extremely good at that. And yet, I feel that this is a far more strategic issue and probably belongs in the hands of long-range master planning type of committee before we render an opinion. So that's the reasoning for my vote.
Thank you.
And now that John has voted no, I will also vote no.
Okay. Okay.
Just
So-
for clarification, though, my understanding is that the board has already stopped this project in lieu of master planning to update.
The board has not voted to stop this.
No, I'm sorry, I probably didn't say that right, wants to update the master plan first.
The board does want to update the master plan,
right.
but this is aside from that. The board will take consideration that properties voted for this to go forward to the master planning. Charter Club voted for this to go forward to the board. We are only one voice in this that goes to the board.
Okay, thanks.
So right now, we are deadlocked 3-3. I will be the tiebreaker, and I'm going to vote that we move this forward to the master planning and not move it forward to the board as accepted right now.
And we want you to know that we respect that decision. In other
Thank you,
words, we
Ken.
believe in the process, we believe in what will eventually happen, and the key is just to keep working the process.
Thank you. And thank you for all your input and the hard work you've done. I appreciate that very much.
Thank you.
I hope Andrew's on the phone. I hope he hasn't been kept too long for what he's had to do, but we're going to move forward with Andrew Maslick with the Vanguard presentation right now.
Everyone hear me okay?
I can, Ken. I hope everyone else can also. Thank you.
I was actually riveted. Pickleball has actually gained a lot of popularity in my neighborhood too. So this is a really interesting conversation to be a fly on the wall. So before I jump in, I'm sorry?
Thank you for your understanding.
Sure. Just so that I'm clear, how much time did you allot for me today?
Pete's telling me 10 to 15 minutes. Will that be sufficient for you, Andrew?
I will do my best. And you have to excuse me, during your portion, I ended up, my neighborhood lost power. So I'm not connected online, but I do have the presentation up in front of me. And if it would work well for you, is someone there that can navigate for me?
Yes, there is. Thank you.
Okay, wonderful. I appreciate that. So why don't we move to slide 5, and I'll provide a little bit of a backdrop here. So slide 5 is titled Total Portfolio Performance and Asset Allocation through the end of February. Quick note, we actually are in the process of elevating a brand new performance reporting platform, so it's something new and exciting to keep an eye out for as we look forward this year. As you may recall, we did implement the update to the allocation back on November 9th, moving from the 40% stock, 60% bond allocation to 10% stock, 90% bond allocation. And part of that plays into some of the data as we see today. You know, if you follow the markets, it was a very strong end to the year, both November, December, ending the year on a very strong note on the equity side. One of the key, I think, drivers is to be kind of mindful of is we saw greater participation, greater breadth and participation in the markets, meaning it wasn't just a very narrow technology-driven and consumer discretionary-driven rally in the markets. It was broader segments. You saw energy and financials actually kind of take the lead in those 2 months. And you've seen greater breadth and participation even entering this year and throughout last week. So this will take us through February. And the thing I'll note as well here, you did see rates rise, in particular the 10-year and 30-year treasuries between 70 and 75 basis points this year. So part of that is impacting some of the values. And if you take your sight here to the market valuation at 25,156,887, as of yesterday's close, you're at 24,972,361. You'll notice the 1 to 3 month returns. You know, that's obviously driven by the rise in rates, and you did see an adverse reaction as it relates to the valuations of the underlying bonds themselves. You'll notice year to date as well at negative 1.73%, although you're pacing ahead of the composite benchmark over all periods, 1, 3 month, and year to date. You'll notice the 1 year here at 8.64% for the year, net of fees at 8.51. You'll notice the composite benchmark at 10.56. The lag is largely due to the timing of the change. So, as we mentioned, November was the best month in the S&P since April, and because we moved out on November 9th, the benchmark is still based on the 60% bond, 40% equity composition through the end of November. So even though you made the move on November 9th, we were still benchmarking against the more equity-weighted portfolio. So that is the key reason why you see that gap there between the returns and the benchmark itself, because November was such a good month for equities, and obviously the benchmark is reflecting that. No need to rebalance at this point. If you take a look at the bottom right, I wouldn't expect that. I did check the analytics and the makeup of the bond portfolio itself. I checked the duration makeup, the yield to maturity. Your current duration is 6.4 years, which is right in line with the broad markets. Yield to maturity is 1.2%. I'll provide some additional commentary on the bond side because I think that's probably going to be an important conversation to have. So let me pause here for any initial comments or questions.
I'm going to just ask my committee, if you have a question when he pauses, please just pop right in. I'm not going to poll everyone with each time. Appears there are none, Andrew.
Wonderful. If we move on then to slide 6. Slide 6 shows those underlying sub-asset drivers of performance, and really to no surprise here, really equity is kind of the key driver over the 1-3 month period and year to date. Your U.S. equity at 7.44% for the 3 months, the international equity at 8.15. In addition to greater breadth and contributor of performance, that being those narrow tech-driven sectors, you did see actually non-U.S. markets leap ahead for that 2 month period compared to U.S. markets. for the year-to-date period is actually pretty close. U.S. and non-U.S. markets are pretty close at about 6.5% positive return for the year. So one thing to keep an eye on is really how those non-U.S. markets perform over the longer term, if this is more of a trend or sustained performance, where our expectation or base case is for better non-U.S. returns over the next 5 or 10 years compared to U.S. returns. I do want to share with you, so I'm going to delve kind of beyond the portfolio here, but slides 7 and 8 here provide you with the breakdown at the fund level, and just really obviously provide some details as it relates to the specific fund level performance. The thing I'll add here as kind of a quick note as a commentary is our fixed income group is the group that is assigned the task of managing almost all of our fixed income products. They really did have a banner year. If you look at our taxable funds, which effectively is the majority of funds that you own in that portfolio, and this data is through October of last year, 100% of our taxable funds outperformed their benchmark over a 1-year period, and 89% finished at or above their alpha target over a 1-year period. So, really, our fixed income group really does have a pretty stellar long-term track record, and they continue to do so. So, we certainly continue to have great faith and confidence in their ability to manage those portfolios as per the specific mandates of each of the funds themselves. I'm going to go ahead and I'm going to jump ahead here just to be mindful of time, but there is one slide I do want to make sure that we have time to review. And I may skip back here, but I want to skip to slide 26 because I think it is really an important slide that is going to really be, I think, a big point for conversation as it relates to the portfolio. So slide 26 is titled Rising Rate Periods and Fixed Income Fund Performances. I was actually reading an interesting piece a couple of days ago that broke down the drivers of bond performance going back to 2007 through current day. And effectively, the aggregate bond market, the U.S. bond market, about 78% of total return during that period was specifically related to yield versus price appreciation. So the best way I can kind of frame this is as a base case, or the best way to think about this is that you will be rewarded longer term from yield or those dividends versus any sort of underlying fluctuations in the bonds themselves. So if for adhering to a long-term strategic strategy, the idea here is that rising rates may not feel good in the short term, which you've seen here, a bit of a give back over the last 1 and 3 months. But this may sound somewhat counterintuitive, but it is actually in your long-term best interest to see rates go up. And what's happening here is every month you're reinvesting those dividends at lower prices and higher rates. And eventually you do tend to make that up pretty quickly as it relates to any give back. History tells you that the time you actually spend in negative territory is typically short-lived. And this slide, on slide 26, is actually kind of a nice overview of that. I'll kind of just display or describe what's displayed here. On the top part of the screen, the grayed out bars are periods of rising rates. The blue line is the 10-year Treasury bond yield. The green line is the effective federal funds rate, which we expect to stay low for quite some time here, for probably at least the next couple of years or so, if not even beyond that. On the bottom part of the screen, we continue those shaded bars, so reflecting periods of rising rates. We go back to 1982, and we provide you with an array of 4 or 5 funds, and these are funds that you have in the portfolio. And what you'll see here is during those grayed out periods, as an example, that long-term investment grade fund, if you take your sight line to 1994, for that 1-year period, that fund was down just over 5%, but you'll notice the next year was up 26%. If you take your sight line, to 2017 with that same fund, the first line, in 2018, that fund was down 5.9%, up 20% the next year. And you kind of see a general theme here. So, for example, if you take your sight line down to the total bond market, which is the last fund listed there, and take a look at 1994 as another example, you do see the next year, 1994 down about 2.7%, the next year up 18%, kind of similar theme. 1999 was down 0.8%, the next year up 11%. So what we're saying here really is that ultimately it's, you got to keep you should keep a long-term focus on this. that inevitably rates will, and we've been talking about this for quite some time, for many, many years, rates will rise, but you will be the benefactor long term, employing a market duration portfolio where you're simply investing across the broad yield curve that ultimately, even though at some points in time you might see some losses, that ultimately those higher yields will come back and you'll be compensated for that. So let me pause for comments or questions on that.
Not hearing any from my committee. Thank you, Andrew.
Okay, how am I doing time-wise?
Well, I didn't start a timer on you, Andrew, so a few more minutes. I want to hear, I want you to give us the pertinent information that we need to make or need to hear.
Sure, so let's go back to slide 19. I'll do my best to be swift and fleet of foot. Slide 19 is a really interesting slide. It relates to notable events in 2020. On the bottom, we identify those various events that impacted investor sentiment. And on the top part, you'll notice we provide you with various indices and how the markets reacted. On slide 20 is kind of a similar slide. What we do, though, is we break down the S&P versus an equal weighted S&P versus market cap and also growth and value. And effectively, what this is telling you is that the markets did respond to various events throughout the year, and 2020 was a unique year to say the least. There were many events that we could note here, and we identified some of the events towards the top, those dotted vertical lines, some of the most notable events that impacted investor psyche or sentiment. But you'll notice, of course, markets were pretty resilient throughout the year and responded quite favorably. And if we go to the next slide, in slide 21, 2020 was the worst of times for GDP growth, debt, obviously. On the bottom right, I would just make a quick note here as it relates to our ability to pay the debt, is that our belief is as long as we're able to service that debt at rates that are below real GDP growth rates, we're not concerned. Obviously, long-term, structurally, that's going to be a concern as it relates to our ability to lessen the amount of our national debt and our annual deficits. But the thought is as long as we're able to service that debt at a rate lower than real GDP rate, that actually should be something that is achievable. On slide 22, 2020 was not just the worst of times, but was the best of times for technology. I heard the term used, Zoomers, here, which I'm kind of curious how this generation that grew up during this period and also through the COVID are going to be viewed upon. Obviously, I think kids in general that kind of grew up during the pandemic. But you'll notice here on the upper left-hand side, this just shows you the daily average users of Microsoft Teams. On the bottom left, this is really kind of an echoing of that earlier kind of title of Zoom customers and other things that we've used more now during the pandemic and their usage rates. The thing in the upper right is really kind of harkening back to what I was mentioning earlier as it relates to greater contribution of market participants. The S&P 500 last year was up just over 18%. The six companies that are commonly referred to as those fan mags, the Facebooks, the Alphabets, the Netflix, and so forth, accounted for 12.2% of the 18.4%. The remaining 494 companies accounted for 6.2% of the return last year. So it goes to show you that it was a very, very narrowly driven market last year, but we did see greater participation towards the end of the year. And I would say that the key metric going to be is how sustainable and how these other companies, the have-nots versus the haves, are going to be able to be successful. And I think if we turn to slide 28 real quickly, this kind of delves into the next final topic here, which is our ability to get back to a sense of normal, pre-pandemic or anything close to it. And some of these businesses that were not successful in a socially distanced world, are they going to be able to then succeed? And will that benefit some of those companies that have been really hurt by their lack of ability to flourish in this economy? And this provides you just our best thinking right now for 2021, our base case versus the downside and upside, and ultimately really showing that economies opening by the second half of this year, achieve infection immunity by the end of 2021, and some general targets. I will make one quick mention here. towards the bottom here in the center, inflation moving towards target in 2021. This has come up. And if you turn to the next slide, this kind of is a nice visual. We are not concerned about inflation. We do believe it's probably going to exceed the Fed target at 2% PCE. But if you take a look at the break-even inflation yield curve, the market is not pricing in significant inflation or expected inflation longer term. So, our base case is kind of inflation going up, probably above Fed target this year, but then, being well under control going forward. So this kind of gives you a visual as it relates to our the movement of inflation and also the core and the PCE forecast. The next few slides are simply growth driven, but I want to be mindful of your time, and I'm happy to dive into some of the greater macro data, which is certainly interesting. But let me pause for questions, comments, and also do a time check.
First of all, I'm going to ask, do any of my committee members have questions right now? Pete, is there more that you feel like he needs to share with us, or on the outlook? Just give us another maybe 60, 90 seconds on the outlook, and I think we'll wrap it up then. Thank you.
I'll start my stopwatch. So slide 30, this is kind of our outlook from a growth perspective. This is kind of the base case for 2021 versus 2020. And in various regions, we would expect somewhere in the round of 5 to 6% GDP growth in the U.S. It's kind of a similar target in Europe, probably closer to 5%. I think what we may find, and we haven't done it yet, is with the fiscal measures taken as it relates to the latest round of fiscal support, that could potentially cause a tailwind as it relates to our target. So that's something that we'll keep an eye on. China's around 9%, world is around 6% GDP growth. So kind of seeing this recovery from pandemic lows. On slide 31, basically what we're showing here is the time it will take to get to pre-COVID levels. So get back to where we were, which is that solid horizontal line we're expecting by the middle part of 2021. To get back to where we should have been as if COVID never happened, we're probably looking further down the line around December 2022. Similar metrics on slide 32 for China, they're already there. And slide 33, I included the UK as well. The expectation is we'll take a little bit longer to get back there for the UK, and obviously Brexit kind of being a key element. On slide 34, this is a nice kind of a visual around support from central banks and fiscal policy, showing the percent on the bottom portion there, the change in policy as percent of GDP. And on the left side on the y-axis is fiscal policy as percentage of GDP. So left side, the y-axis is fiscal policy. The x-axis is monetary policy. Kind of gives you an idea of where the U.S. sits as it relates to some other regions, including China and Europe and such. Obviously, the U.S. is taking a pretty aggressive stance on both fronts, on both the monetary and the fiscal side. Slide 35 is important as it relates to our outlook. It basically what it's telling you here is that we would expect that the probability of a correction or a drawdown to be heightened this year compared to average, what a normal environment we would expect. So the normal environment is identified by that dotted horizontal line. What we're saying here in 2020, and over the next 3 years is that we're expecting that there's a greater likelihood that you would expect to see a correction of that in the measure of at least 10%, and even that of 20%. You kind of saw that in the NASDAQ if you follow the markets, where the NASDAQ did actually enter correction territory, what was it, last week or so. The last couple slides here is our outlook as it relates to sub-asset classes. Slide 36 is the equity market 10-year outlook. And if you take a look at the very bottom, that's your global equity outlook. So it gives you kind of a breakdown of what our best thinking is as it relates to both U.S. and non-U.S. markets. Once again, if you turn to slide 37, you'll see there's a bit of a distinction or difference between U.S. markets. On slide 37, which is defined on the left side, that 4.7% expected nominal return over the next 10 years versus non-U.S. markets as an aggregate of 8%. And the between the two bars, provides you with what's driving that, what's causing that, whether it's valuation contraction in the U.S., earnings growth, a higher dividend yield in non-U.S. markets, and a depreciating dollar, which causes additional return in U.S. markets. So it really gives you a nice look under the hood of what is causing our thought or impacting our thought related to U.S. versus non-U.S. markets. And we'll end on where I guess, a place where we started at is the outlook for bonds. And the thing I would make mention here is keep an eye on not just the broad, bond markets, but also inflation as well. These are things we talked about over the last few months. I know is that we want to be mindful both from risk mitigation in preserving capital, but preserving capital on an inflation adjusted basis. So in real terms, so even though let's say your yield to maturity is 1.2%, we want to keep an eye on what the expected inflation rate is. So we're not just maintaining the corpus, but we're allowing that corpus to grow at a pace at least aligned with that of inflation. So we'll keep an eye on that. And these are the various breakdowns. But I would say, I guess a common theme on the bond side is that we would expect, expected low returns across the curve for the next 5 or 10 years. Let me pause there for final questions or comments.
Are there any questions, comments from a committee? Appears there are none, Andrew, and I have not gotten any from our audience either. Any of our board members here have any questions? Okay. Pete, do you have any final comments? Well, Andrew, appears we have no questions for you. So I thank you very much for your presentation, and thank you again for bearing with us during the delay. Thank you.
Thank you. Thank you all, as always. Happy to chat offline, one-on-one. And I'll be curious to hear how the pickle court adventure goes.
Thank you very much, Andrew.
My pleasure. Be well.
Okay, we're going to move on to the next item of business, which are our financials for January and February. And I'm going to turn this over to Pete. It's going to be the Pete show for the rest of this meeting.
Well, thank you, Ann, and again, good morning, everybody. We do have multiple months to present today. January's income statement is up first. For revenues, the impact of some weather closures for about 4 to 5 days impacted our golf fees negatively. Additionally, COVID-related impacts on revenues were felt in membership, with guest fees being virtually non-existent and tenant cards being well below normal run rates. COVID was also felt in bowling, with continued lane restrictions and special events where obviously no events were held. Restrictions for the golf course pro shops negatively impacted merchandise and food and beverage net revenues, and all told, these impacts resulted in a shortfall of $309,000 against our budget expectations. On the expense side, there were some favorable variances against the budget expectations that resulted in $112K favorable to be offset against the revenue shortfall, and of course then the result was a negative variance of $196,000 operating margin for January against the budget. Moving to the capital-related portion of the income statement, bond and stock valuations that Andy just referenced were impacted by the rapid increase in the U.S. Treasury 10-year rate, resulting in a $221K negative impact on the Vanguard valuations. Continued strength, however, occurred in our APF transactions with a $46K favorable variance. So all told, capital-related had a negative $176K performance in January, translating to overall a $372K negative impact for January. If you could move to February. Sorry about that. February rebounded on many fronts, starting with revenues. Golf fees had really no material weather-related impacts, so much like in the first 6 months of our fiscal year, golf once again had a favorable variance of about $9K. Negative impacts in many of the same categories I mentioned earlier in January reoccurred, such that overall revenues were short to budget by about $143K. Expenses, however, in February had a much greater favorable variance in virtually every category, such that there was a favorable variance of budget of $261K. And of course, this then translated into a favorable operating margin of $118K for February. Capital related continued to have both strength and weakness, as the interest rates negatively impacted the Vanguard funds by about $293K, mostly within the intermediate and long-term portion of the bond portfolio. Yields, however, have remained at just under 2%. The APFs continued to show strength, outpacing the budget by over $50K. And so overall, therefore, capital-related was a negative $221K, which when combined with the favorable $118K operating margin, created a negative variance of just over $103K for February. Moving quickly to the year-to-date portion of the income statement on February, revenues were short to budget overall by $668K, mostly in the COVID-related impact areas that I mentioned earlier: guest fees, bowling, special events, and food and beverage merchandising. However, operational expenses remain very favorable to budget due to open positions within staffing, some facility closures, much less repairs and equipment purchases, which translated to a favorable variance year-to-date of $1.4 million. Year-to-date, therefore, the operating margin is a favorable $769K through February. I would mention that despite the reopening of many of the association's facilities yesterday, shortages against the budget will likely remain in guest fees, tenant cards, bowling, and special events. So it is anticipated some of this favorable variance that we have through February will be needed in the final 4 months to remain at or above our budget by year end. Moving to the capital-related portion of the income statement for investment income, when the Vanguard funds were rebalanced from a 60-40 ratio to 90-10 bond ratio, equity ratio, there were capital gains recorded into the investment income. This is the reason why there's a positive variance year-to-date on that line. For realized and unrealized gains and losses, although the last 2 months have had some negative impacts, year-to-date there's been $1.1 million favorable gain through February. APF's year-to-date strong housing sales have contributed $390K more than anticipated. Next few lines: fewer disposal of assets with residual net book value, and the delayed capital spend that has been discussed in previous sessions have both favorably impacted our gain on loss on asset disposals as well as depreciation. So overall, therefore, as of February year-to-date, the excess of revenues versus expenses is about $3.5 million compared to a budget of $689K, for a favorable variance at this point of $2.8 million with 4 months remaining. Against prior year, strength in golf fees and ancillary revenues offset many of the COVID-related impacts, such that our revenues are up by $91K. Expenses are down by $284K for an overall favorable variance on the operating margin of $375K. Capital related, the strength in investment valuation growth in APFs has had a favorable growth of just over $1 million. And therefore overall, the current year is ahead of prior year by $1.4 million. Any question on any of the two income statements?
Lou?
Membership down 179. What's the reason for that, Pete?
One of the key items in there is guest fees and tenant cards. Those have been taking sizable hits.
Great, thanks.
Any other questions? John?
Yeah. And thanks, Lou. That was number one question. But I was looking for reconciling the fact that APF is up, ownership is up, and members would be down. It seemed counterintuitive to me. So thank you.
Sure.
But can you just refresh my memory, and maybe some others, recreation, can you define recreation and maybe give a couple examples of what revenue
Sure.
we lost in recreation?
Yeah, it's a big one as well. The largest component of that is our hall rentals. They virtually went non-existent. That can be tens of thousands in any given month when the clubs are in full swing.
Okay, and then could you expand just a bit on what is the recreation division? What does it entail?
Are you talking about when we're in the budget breakout or?
Yes,
or this,
budget breakout and here the line item that says recreation.
The first was the answer I gave on the halls, the social halls. I can actually, I do have a Excel spreadsheet if we wanted to dive any further into that, but generally
The
speaking.
top line answer is good. I just want to make sure I understand it and that others understand that term.
Sure. Another big one is tours. All the tour revenues goes into that. And all those have obviously gone non-existent.
Thank you.
Any other questions from my committee? Any of the directors who are here, do you have questions you want to ask? No?
Cool.
Okay. Is this all you have on the
It
financials?
is, and then capital and
Okay.
and
I
budget.
didn't want to move forward
Yeah,
off of
that's it.
financials until I knew you were totally finished. Do I have consensus that these will be filed and move forward to the governing board as accepted and filed? I'm seeing lots of nodding heads, so I'm taking that as a yes. So thank you to my committee. Pete will now give us an update on our capital and reserves.
Thank you again, Ann. For the capital update, the governing board approved a capital purchase of $5.9 million for the current fiscal year. Year-to-date, Katie, you can advance. On that $5.9 million, purchase orders have been issued for just over $4 million, and a little over $362K on carryover projects from the prior year. If you'll move to the next one. On that $4 million of POs issued, for completed projects, there have been $282K of savings against the budgeted capital spend. Items that remain, the next one. Items that remain unordered currently include about $876K for the Palm Ridge parking lot and lighting project, as well as $170K for the R.H. Johnson locker room flooring. As both of these are now moving towards ordering, it is anticipated, based upon some bids that we've seen, that both of these should manifest themselves with further savings, although I don't have absolute concrete numbers yet. And there are 17 other smaller dollar projects and pieces of equipment totaling $240K that we're making every effort to get completed by year end, so as to avoid any kind of high level of carryover, although that is by our own policies, that's not mandatory if the capital items timetable does not make sense to begin. And lastly, on the allowances, the governing board authorized $435K annually for the fiscal year, and about $240K of that has been expended, leaving a balance of $195K for the remaining 4 months. And lastly, moving on to the reserve funds and the fully funded balance / future new capital percent. The funding of those, the current projections right now call for about 54% of FFB at the June 30th. All of these, I wanted to make a note. I mentioned last month that we had 2 different models, and now these projections on the one I'm presenting here as well within the budget are now in sync, so there's no variance between the 2 modelings. Real briefly, I know it's highlighting, maybe it doesn't show up too much there, it's highlighting the budget column for the next fiscal year, but the one to the left is, of course, the one I want to discuss briefly. Just going through each line very briefly. You heard earlier, our operating cash flow right now, we have a favorable variance of $769K, so the $1.7 million in the projection should be attainable. Moving to the next line down, the investment earnings and gains loss, we're at about $1.7 million year to date, and so that very well may come up short against the $2.4 million currently shown, and of course this shortfall has occurred due to some of the valuation declines that have been incurred in the last 2 months that we mentioned. Next line down on APFs, continued solid recent months should make the $4.9 million attainable. We just got to keep our eye on the increasing mortgage rates. Hopefully will not dampen any strength within the housing market, but I don't think the rates have gone up that much yet. And lastly, on the inflows on the capital spend, the encumbrances should be at or below the prior year 2.5 million carryover. Moving to the outlays, you heard earlier that on the 5.9 million spend, we currently have over 300,000 of savings, and that amount should hold up, if not improved. And so I think we're well positioned to stay at or above our 40% mandatory by policy threshold, if not much more solid than that as we go forward. Any questions on capital or the reserve funds?
I have one question, and I see Carl's not here, so that probably would have gone to Carl. But when we look at the open capital budget items, there's the Palm Ridge parking lot and lighting for $876,000. If pickleball were to expand to Palm Ridge, I'm wondering if that would, if we should be doing this right now. I know the parking lot's in terrible shape, so there's no doubt that it needs to be done, but I'm just wondering if we're doing something that then we're going to have to tear up. So, George?
And thank you. Just, I know Carl mentioned this probably back in October or November, that he has this apportioned out where he would do the Palm Ridge parking lot, and if pickleball was going to expand in that area, that part would not be done. It would have been a reduction, but the full amount is in there for the full parking lot. That's, I don't know if I explained that right.
No, I think you did. That he's already aware that there could be a part of it that would not need to
That
move
is,
forward if pickleball were to move forward.
If I remember correctly, which is probably feeble in my mind, that it would be, I think it was 1/5 of the number, of about 20%, Pete?
The update is we're going forward.
Okay.
There were some mathematics that were put into it. One of the reasons is when you're tearing up and you're bringing all the equipment in to do the milling, there's a pretty sizable start and stop component of that. And so the price in a future, if you left that 1/5 undone, and now you've come to a year from now, master plan's done, and you've said, we're not going to progress. I'm just saying, what if we're not progressing with pickleball, then you have that 1/5 less. The price actually got pretty sizable. So the decision has been made that we are going to proceed. The roughly 750,000, I've got good news on that. The bid we got from YSC Paving was about 550,000. So be about 200,000 on the capital spend, and you can do the simple math that it'd be about $100,000 exposure if somehow Palm Ridge was the chosen one that for ripping it up. So yes, there is some exposure, but we did some mathematics against it and decided to go forward.
Thank you. Well, it's good to know that so much thought has gone into that, and I'm aware that what pickleball is asking for in the budget for 2021-22 is only to look at some architectural engineering, that type of thing, so nothing would happen before 22-23, and obviously we can't leave the parking lot in bad shape, but it's good to know how much thought has gone into that.
Thank you.
Anybody else have questions? John?
I have a question. Pete, could you give me a very quick and dirty a comment on if the pickleball project were to go ahead? My personal feeling is it's just a question of where and how and who and things like that to keep our community vibrant and competitive, as Kathy commented earlier. We've got all these line items of some pretty significant capital jobs here, and I'm sure you would add that, but could you give me a quick and dirty at just, if we were to add that in here, what that would do to the ratio?
If you could go to that reserve study, the last slide on this presentation. It's a little small, but if you will note out to the, right in the middle, you see the new capital component, right? The current next coming year has about 800 and some thousand. I left a relatively sizable accommodation for the future, I mean, it's going to include other projects, but against the run rate, 1.2 million and then a capital, or excuse me, an inflation factor on it after that. It's just, you know, the master plan will define a lot of this, but 1.2 million each, the next couple of years would make big inroads, especially if the Kuntz project was at the lower end of the curve was selected.
Thank you.
Any other questions from the committee? Oh, Lisa, yes.
I have a question. I'm just a little confused, so maybe I can just get clarification somewhere. It's regarding the garden club. And I know we addressed this back in, I think it was January. It's been so long, I think, since we've met. So I just think maybe, I know we approved for it to go forward, and we all want to see it in the budget for the 300,000. But I think there was some confusion as far as the 30,000 and the $120,000 loan. And I saw somewhere, and now I can't find it, I was trying to scroll through here, that I thought I saw it in the proposed budget for 300,000. So I just want some clarification. Are we going forward now with it in the proposed budget for the full 300,000?
The answer is yes. For any of fiscal year 21-22, we're not looking for any club-funded contribution. The largest component of that, especially as it pertains to funding, is that if the payback mechanism for the garden club was to be over a 6-year, 7-year period as they proposed, they're actually entering into a contract which by our own bylaws doesn't permit. 1 year is the maximum the governing board can enter any contract. So the decision is to allow the governing board decision to be based on the merits of any project, solely on the merits of the proposal. As you know, in this instance, there is an expansion in there, but you've been privy to their presentations, and hopefully the governing board will decide if that warrants the additional expend or not.
Okay, great. Thanks, Pete.
Lisa, just to explain to you and the other members, the items that are in the budget, and we're going to see an update on the budget in just a moment from Pete, but all the items that are 50,000 or over, when the governing board votes on the final budget, those will be line item votes, as I understand it. And
Yes.
so, and the Budget and Finance Committee will also get to do some line item voting on what we move forward. So we're still in the throes of the budget process, and it is a process. Any other questions?
Yeah, I'm just still interested in seeing club debt versus what the association is paying.
Right, and
So
that's-
it'll be hard to, it would be nice to have it before we have to vote on a budget.
I agree. Thank you. Gary, Lou, Harry.
Pete, just a question then, with that 1 year thing, does that not also affect then what Pickleball is proposing when they're
Most
saying
likely, most
12 to 15-year payback?
Well, that's why I think we need to see the big picture of everything.
Correct, and we will before the final decisions are made.
Madam Chairman, Harry, you looking at me for an answer on that one? I will absolutely answer that in the most politically correct way as possible. As we sit here right now, and as we go on there, it is in the hands of our attorney, our tax attorney. And at this point, I cannot give you an educated or even a nebulous answer to that. Because again, realistically, I ain't a tax attorney, and I ain't an attorney in Arizona. But we are concurrently waiting for this. This has been an ongoing process that has been, was brought to us probably a number of years ago. And it's just something that I wish I could give you, this is the answer, but right now, it's not. I can't answer it. No, yeah, it's one of those situations where I'm not good.
Well, that just says then projects going forward are going to be sitting for a while till we get an answer.
That is correct. And that's kind of why when we thought with this, we looked at this process that was out there, and the idea of looking at the community as a master plan with that portion of being a question mark of not moving forward, we have that time out where we can sit back and review not only our spaces, but what we have, what we don't have, what we need, and where we're going to go. And not that you ever want to have attorneys involved in anything like that, but it was the golden lining that came out that we have the opportunity to take that step back and look at exactly where we need to move forward individually. And each, you have to look at it this way. You look at 105 clubs that we have, each one is a separate individual entity unto itself, and you have to, each one handles itself differently. I mean, like my old favorite club here, my ice skating club that's out here, you know, that's my example all the time. Their needs are much different than pickleball needs would be. You know, and those are the things that we have there. But that's the best answer I can give you right now. I don't like giving nebulous answers either.
Well, it's understandable, though.
Thank you.
Excuse me, any more comments or questions from my committee? Okay, Director Heddick.
Is this on? Okay, Gary, and when you meet with the other gentleman that was making the presentation today, could you verify how many outside visitors they actually receive money from? How many of them are actually in Sun City West versus outside? Because he didn't really give that information. Okay? Because there's a difference between what they're making in revenue back from outside versus what's in.
Any other questions from directors? Anyone else? Okay, thank you for the update on capital and reserves. Pete, we're going to go ahead with the updated 2021 budget packet that includes the 5-year plan. And Pete, I'll turn it over to you once again.
Yeah, this will be very brief. Katie, if you'll move just one more slide down, and then one more, I guess. So this is the latest budget iteration. Budget has had some changes since what we presented on to this committee on February 16th. 3 major changes, all of them were increased expenses. One of them was a request to make a higher investment in our master planning, as it's such an important task for our association in the future. Also, a review of our health insurance expense we deemed was not adequately funded in our first pass of the budget based upon the current year's monthly spend and anticipated increases next January. And lastly, although the association itself has not had any claims against our property casualty insurance, national impacts such as elevated hurricane and fire claims, plus higher jury-awarded personal damage settlements have caused many carriers to leave the marketplace. And as such, premium increases of 20+% were predicted by our broker. So an increase was made there. Overall, therefore, the operating margin was reduced by about $300K from last month to the current approximately $1.5 million operating margin. We didn't make any changes to the $5.8 million capital budget. And even with these changes, the 5-year reserve fund projection remains in the low 50%, again, well above our 40% FFB floor required by our association policy. So, any questions on the budget?
Well, I've got a couple of questions. One, I don't know if I've asked you this before or not. I've got it written here in my notes. Why is golf projected less for next year than over our current year projection? It's going down 5%.
Yeah. I don't know the right phrase is conservatism in there, but 2 things that we realized in the current year, Ann, was that the weather-related impacts were virtually non-existent in the current year. Virtually non-existent. Like, we went almost 170 days without any delays. Now, granted, some of that was in our non-peak period, but literally from October, November, December, it was almost a surprise actually to see January with 5 days when we had that kind of that nasty weather. And so that has promulgated part of the round rate numbers that we've seen in the current year. The second, and it's a hypothesis only, is that golf in the early stages, and I was just bantering with somebody about this yesterday, that it kind of remained one of the few acceptable alternatives to recreation outdoors in the very initial phases of COVID. And thankfully, it's retained some of its strength, but maybe it's a conservative posture, but we were concerned about when all the rest of the activities are reopening, would golf relieve some of its surge. We didn't go back to pre-COVID levels, but relatively close to that. And so I do hope that for the Golf Association and clubs and everything, that this conservative posture will be exceeded, but I didn't want to be on the wrong end of that curve either.
I appreciate that. My other question is about the APF, the asset preservation fees, which are going up a little over 5% next year. And we're also, I believe we're going to get the bulk of the new homes that are being built in our community. So I'm wondering why that is projected less. It's not tremendously over the actual for 19 and fiscal year 20.
Andrew might disagree with me a little bit, but I think you are starting to see some of the 10-year note. And, you know, if inflation did rear its head, the first place is going to be a Fed reaction. He did expect it to remain low, and if those hold true, theoretically mortgage rates, which I think have crossed a little over into 3% now, up from they were in even the mid to low twos, if I'm not mistaken, not too long ago. I'm not saying that's going to put a screeching halt on it, but I don't know if the days, and you got a lot of realtors, you know, here that would tell you that, you know, the homes are sitting on the market for 24 hours or less sometimes. And I don't know if I maybe just have a conservative CFO posture, but I'd rather exceed to the upside than to go to the other end of the curve. So,
As a former budget person, I think my nickname where I worked was Budget Bitch, and I think I earned it. But I understand the overstating expenses and kind of being conservative on your revenues. So I understand that very much, Pete. But I just wanted to point those out. I'm just going to go around person by person. I'll start with Kathy. Do you have any questions?
Just a clarification because I haven't done a complete cycle here yet. But at the end of a fiscal year, if you have $2 million excess revenue, does that drop into investments?
yes, there are two components. The capital-related component happens real time. Anytime the fund valuations change, it's happening organically. Anytime there are dividends and interest, it's happening. It's going right into the reserve funds. So it's happening as we speak. But on the operating margin by policy, right now it's budgeted at 1.7 or so, somewhere in that range. My prediction by policy, we do a true-up, and those funds are, by December 31, those funds are positioned into the reserve funds by policy. So it's important. I've made this distinction before, and I think it bears repeating. This association does put a heavy reliance on its APF. For our reserve funds, it's, I think when John and Lou helped me and Terry, assisted, we made a pretty large distinction that almost 70% of our R&R funding or new capital funding comes from that source. And so I guess to your point, Ann, I'm very conservative on making sure that we don't have a unattainable number or even one that presses such that we have to go to the association and say, whoops, we missed on that one. So maybe that's built into my analogy a little bit. But again, the second component is almost 20% comes off the operating margin, and in the last historically has been coming off the dividends and interest. And the point I want to make on that is, when you think about other associations, or maybe in your own individual HOA, most of you will see a component on your annual dues that'll be anywhere from 10 to even as high as 20% for repairs on the park or the pool or the, fence. And we don't have such a distinction. The only thing that occurs into the R&R is that operating margin. And so if historically 1.5 million is our budget for next year, you divide that by roughly 30,000 members, and you get a $50 per person assessment, which in $50 into your dues of roughly $500 is about 10%. So I think owner members get a benefit in it against other comparisons that I've seen, at least in 15 to 20% range for that line. So, answer to your question, it's an important part of our funding. We don't do it just to, so to speak, have an excess that it is unrelated to the goals of the association.
Thank you, Pete. Kathy, did that answer your question? You have any more? Gary? Lou?
Pete, good job. No questions.
Lisa?
No questions. Thanks, Pete, for your presentations.
Harry?
Thank you.
John?
Yes, a comment and a question. First of all, Pete, this is a compliment. Your grasp of the connectivity of all of these line items in capital budgeting and operating budget is astounding. I continue to be very impressed with it. That's the comment. The question is then on the plan. At the last portion of the plan, you break out in pretty good detail all the projects. Do those projects for fiscal '22 tick and tie to what's in the summary? Or are they just a separate schedule?
No, they should tie.
They tick and
Just
tie?
to make sure I'm referencing, if you'll page down like 3 times, 4 times maybe.
It starts on
Right
page
there.
9.
Yeah, that right there.
Yeah.
Yes, all those items tied to the 5.9 million.
I didn't bother to add them up in
No.
preparation for the meeting.
If you'll go down about 6 more times, right there is a summary, and all the items within the future 4 years are also drive right out of our reserve study, so, yeah.
Thank you. I was hoping that was the answer, but I didn't take the time to add them up. Thank you.
No worries.
Utterly shocked. John, Lisa and I are sitting over here just very embarrassed for you that you didn't get out your calculator and add them up. But
John, I am appalled. I'm just appalled.
Had this not been given as a PDF, but as an Excel, I would have put a summary down there and
No,
done it. But,
John-
or gotten Lou to help.
just so you don't feel like the Lone Ranger had been in Excel, I would have done the same thing. But I do have faith in Pete. Okay, hearing no other comments or questions from my committee or any of the directors present, would they like to make any questions or comments?
I would. I'd love to thank this committee for the hard work they've done. Pete, great job on this budget stuff. And it's one of the great things that we have here is knowing where our finances are. And it fluctuates from month to month. But overall, I have to absolutely give kudos to the overall picture, not just what happens last week, but what has happened since July when we first started on this budget journey of this year is really, really, really important. And I cannot thank your staff enough for all they do. They're just in great and great committee, just a great committee. Thank you. I know you guys are just amazing. I mean, the only other comment I want to make is to Kathy. Kathy, when you said about that when we transferred to reserve funds, just so you know, that is only after the audit. The audit people tell us what the number is. We don't just automatically do it. That's they give us the double blessing, right, Pete?
True.
Thank you.
Okay,
I'm sorry. They like the Pope. Kinda.
Yeah.
We have a miter for them.
oh, this This committee's getting to be almost fun. Do I have any more general comments from the committee on anything? Any general comments, questions from the directors who are here? Have we gotten any comments from people? Oh, thank you. Did you say that out loud? I did say that out loud. Well, I'm taking it as a compliment that you all have asked good questions, that our presenters have done their job today, and it's been very clear to people. Of course, it may be that they need to be woken up after sitting through this meeting, but we hope that's not the case. Oh,
See, that's
Luke.
why, see, and that's why I should be sitting where John is.
That's
Oh,
true.
I understand
Well,
now, Kathy.
we did not have Karen to put out name tags to name things today, so we mixed it up a little bit. Anyway,
And I do have one question.
sure.
And Pete, it's regarding the capital reserve, and it is in regard to the individual funds that we have. Any oversight on that? I know we had talked one time about I call it a subcommittee, a group that would review those and staying within our 90-10, possibly move, more short-term, long-term, that sort of thing.
So update on, I think the RFQ is what you're referencing. You were
Right,
part of that
right.
committee, and John and Terry. Speaking of that, tomorrow, we did set a response date of March 9th, and we did receive 3 qualified RFQs. Ann Brown, Bill, and myself will be looking at the proposal documents and then setting times for their presentations probably towards the end of March. And one of the reasons for that is I think Bill will be out next week, and so he's a key component of that. I think Andy probably put it in the small print up there, but our bond portfolio, as you know, is divested over thousands of, it's all index funds, so, and mutual funds, so it's not an individual bond, it's literally over the thousands at Vanguard, and then, of course, those are spread out over long-term, intermediate, and short-term portions with, don't hold me to this, I think of the 22 million in bonds, at least 4 to 8 of that is in short-term, 30-day to 60-day. Another 3 million is in the long-term, and like 4 million in the, so as you kind of heard him say, we can respond to short-term interest rates when we're not fully vested in, long-term maturities. So I think it's set up pretty good for that, even if you can get have some impacts in the short run. But I'm kind of anxious to see what our yield is, with the, upcoming April and March results, because theoretically some of our short terms have matured even since, the interest rates started to increase. So we should do a benefit on the yield, and I just want to see by how much.
Okay. Thanks. Yeah, I'll be interested to see that as well, and the results of our financial advisor. And thanks, Pete.
Our next meeting is scheduled to be April 6th here in the Social Hall at 9 o'clock. And with that, our meeting is adjourned at 10:44.